Good morning, Kyle.
Good morning. How are you?
I am terrific. What have we got going for our show today?
We have Carol Ann Bozarth, our mortgage expert, to talk to us today after stats. And then if we have time, we'll see some properties.
Sounds good to me. It's a wonderful day in Chicago. Happy spring to you. You want to get going with stats?
Let's do it because we have a lot of stuff.
Okay. Yeah, we've got a lot going on today. Let's get it going. This is the Lakeview Township, which goes from Fullerton up to Devon over to Western. And North Chicago is basically river on the south, river on the west, lake on the east, and Fullerton on the north. So the big story is month's supply of homes. First, we're going to look at attached here. There's still more homes that are condos, but it's not a bad market. It is what we call a static market, neither a buyer's market nor a seller's market. We've got 6 months worth of inventory. Now, if you're in Lakeview, the condos, less inventory, it's a seller's market, 2.7 months worth of inventory. Single family homes, whoo! Very little inventory, people, very little inventory. Look how low this is for single family homes. Holy smokes, we don't have enough homes for sale.
And I keep telling people that, and they're like, yeah, I don't believe you. And the answer is it's true.
It's true. It's true.
Yeah.
Okay. And the reason it's true, look at the homes under contract. Now, this is attached. This is attached. So the month of March was like the highest in ever.
Wait, go back. So what's red? Red is, okay, they're both, look at that. For both, look at how many there are. Holy moly.
Both townships, yeah. Basically downtown Chicago's hot. And then wait till you look at single family homes. Especially in Lakeview, we are off the charts. It's like 50% higher than any month ever.
But also remember, there are more single family homes in the Lakeview Township than there are in the North Chicago Township, because that's where the taller buildings tend to be located.
Very good point. Very good point. But
still,
if you look at it, hot. Yeah, hot. Okay, then I thought it would be interesting to look at price per square foot. And I'm not so concerned with this up and down thing, because I think it might be also related to the types of homes that are for sale. You know, if you've got, smaller homes, the number's going to come down. But
Sandberg, for example, selling like hotcakes in the 2s and 3s. Absolutely. Selling like hotcakes. Got it.
So just kind of think about it, though, in terms of numbers. Like, what does it cost me to buy? It's $334 for a condo downtown. It's not a surprise that a condo downtown, like in North Chicago, near North area, costs more than in Lakeview, right? It makes sense. Okay.
Absolutely.
Single family homes price per square foot.
Wow.
Yeah, it continues. See, people want to live in single family homes in downtown Chicago. So, boy, oh boy, if you've been thinking about selling your single family home on the north side of Chicago, now's a really good time to do it, people. Yeah. So that is the story.
All good things. And
all good things.
And we keep seeing, so for example, the weekly data that I publish on my Facebook page and on LinkedIn shows that we were down a little bit for closings last week, but we are so up on under contracts that we're just, under contract is a leading indicator of what's coming in the future. It's just unbelievable. Yeah. We are a very hot market, and there are a lot of people who are disappointed because they're losing out to other buyers, other bidders. And that's why we thought it would be really important to bring back Carol Ann Bozarth, our mortgage specialist, who can tell us sort of how to be ready and put yourself in the best possible light so that you can, if you're a buyer, be a winner. Anyway.
Absolutely. Welcome, Carol Ann.
Good morning. How are you guys?
We're terrific and very glad to see you. Having you on the team is very important to us because we can't get these deals done without you. And as Kyle said, it's really good to have you on to talk to us about how these buyers can win in today's market. So we have a list of questions curated from our clients, and I guess we should just kind of run through them. What do you think, Kyle?
Absolutely.
All right, I'm ready.
All right. Well, first of all, give us a sense of where we are with rates and what somebody can expect when they're going to look at buying a home.
Yep. So rates, of course, are still historically low. Rates have been holding steady. We're still talking. Of course, single-family home rates are lower than condo rates. The reason for that is that the lenders view the condos as higher risk, of course. So single-family homes, I locked people on Friday at 3%. Of course, rates are driven by your credit and by loan to value. There's lots of things that factor into the rate, so it's a little bit dangerous to just say what are interest rates, because interest rates are really specific to the deal and to the profile of the buyer.
Gotcha. But 3% right in the okay.
Yeah. All right. Yeah. Condos a little bit higher.
And give me a sense too of the relationship of interest rates, jumbos to conventional, and tell us what the conventional number is these days.
Yeah, so the conventional is what I was quoting at the 3%. Jumbos are a little bit higher, but they're still in the low threes. Jumbos are, Key Mortgage has about 4 different investors that we work with. And jumbos, they do require a little bit more as far as there's some unique guidelines to the jumbos, but it used to be that jumbo rates, people were doing everything they could to get below that jumbo number. And it's just not that necessary now. It's like you don't have to empty out your bank account to get into the conventional range. I mean, the jumbo rates are still in the low threes. So
I think some of our people don't know the term conventional and jumbo. Could you give us some definitions for that?
Sure. So anything under any loan amount under $548,000 is conventional. So any loan amount under that, and then anything over is a jumbo on a single family. Yeah.
And does jumbo also refer to the type of loan that you're getting? You're not getting a government assisted loan, it's a bank loan, or is it just under that amount?
Just under that amount. So when you're under that amount, there are also other options. We're talking, there's government loans like FHA, VA loans. Those are 2 other types of loans. So if you're under that amount, obviously you could be also in one of those other programs. But it's really the whole jumbo and conventional is all about the number. Yeah.
Got it.
Yeah.
Got it.
Yeah.
How long does it take to get approval for a typical person from calling you with a property and thinking about getting a property to the end? How long does it take?
Okay, so for me personally, because I'm Johnny on the spot and ready, it depends on how complicated the documents are. But typically, I mean, if it's an average person with, they're not self-employed, they don't have a gazillion things going on in their financial life, I can issue a pre-approval letter in 30 minutes. I mean, it's a matter of having a phone call with the buyer, having the buyer provide all of the documents, and having me review the documents, and then running the file through our system, getting an approval, and issuing the letter.
So that's for the pre-approval. And then if they come to you and say, okay, I've got my contract, we can close as soon as you can get the paperwork done. How long would that take you?
How long?
To get them approved, to get them through underwriting and get the clear to close?
Again, we're saying we could do 30 days right now. But It is also a very busy time. So we ideally like a little bit more so that it's not so stressful for everybody.
Now, you all have done a bunch of hiring lately to make sure that these loans go through more quickly, right?
Yep.
You got a bigger processing group and.
Right. Yeah. Key Mortgage has done quite a bit. We're continuing to hire. We had that perfect storm last year where we just got caught, which was everybody. So we're trying to avoid being that. And this market is still continuing to be so crazy. I mean, we're just so busy. So we're finding solutions to still try to meet the 30 days. But ideally, it does get stressful for everybody when we're trying to do those short closes. The buyer has to be very responsive. I mean, like when, there's a bunch of stages along the way that require signatures and more documents. And so if your buyer is not supplying the necessary information in a timely manner, it puts everything back. So it's kind of like if you want to do a short close, everybody on the team has to understand that it's going to be a little bit of pressure, but if everybody's willing to do their best and get things in, then we're still able to do that. But I don't know, it gets nutty at the end. I mean, so a little extra time is always nice.
Well, the reason we ask this is normally what I do is I put 45 days just so that, because often buyers will have a problem getting the documentation or the work gets in the way, blah, 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 blah.
Right.
But a lot of sellers are looking to leave. They want it done. And so that's why the 30 days comes up. Yeah. And so you're right. We have to join hands with our buyer clients and say, to get this property, we're going to have to do a 30-day commit to a 30-day close, but that means you're going to have to be Johnny on the spot with the documentation so that our lenders can do that.
Right. And just so you know too, as for you guys as agents, the first thing that we need is that executed contract. So we can't start anything. That's literally when the clock starts ticking for us. So if you guys go under contract and it takes us 3 days to get the contract because they haven't signed it or the seller hasn't signed it, it's like, don't let the seller hold you up. Like, explain to the seller, listen, you're asking for this 30-day close. My lender is, and this is a conversation you have with your lender. Okay, can we do this? Yes, we can. But if you literally those 3 days that the seller it's taken for us to get the contract is like, it's like so incredibly valuable every day in a 30-day close every single day. So get the contract, let the seller know we need that signed.
When fixed rates are higher, people look at doing adjustable rate mortgages. Is anybody doing an adjustable rate mortgage right now?
No.
No need, right?
No
need. My first home was like a 10% mortgage, and and plus there's that reason. Yeah.
My first was an ARM, first loan.
Yeah. Nobody, not a single. I haven't had a single person. And the other thing, interesting aspect of that too that we talked about is about the down payment. Like, how much are people putting down or not putting down, and the rates being so low. To be honest, I'm even having people put down less money. They want to keep their money invested in wherever they have it. And they're looking at it like, I can either, put 20% down or 40% down. But the interest rate is 3%. And even, my financial advisor is telling me, get a mortgage. You can pay cash, get a mortgage. Right. So it's kind of interesting times as far as that goes.
Should we run the numbers and talk about PMI a little bit, ladies?
Okay.
Should I share my
I just want to go back to our buyers who are thinking of, can I just quickly, our buyers who are thinking of paying cash, you can make a cash offer and still get a mortgage.
Good.
The cash offer says to sellers, I'm not going to make my ability to get a mortgage your problem. Assume this is a cash deal, but I'm going to go get a mortgage. You can do that and we can help. Okay, here goes.
Yes. Right. So you've got the benefit of being very viable as a buyer in the seller's eyes, and at the same point, making your financial goals.
Yeah. So, and do you know what comes up in those? What spooks sellers about those, like why not just have a cash offer, is typically the appraisal, right? And so the other piece behind that with that offer that we're seeing is that the buyer then offers, if the appraisal comes in low, I will also cover that amount, right? Because in a cash offer, you don't have to have an appraisal. So the seller doesn't have to worry, well, if my house doesn't appraise, it doesn't matter because there's not going to be an appraisal. So that's another piece to it. And then, of course, in those situations, you want to make sure, if you guys are on the listing side of one of these, you want to make sure that the buyer has the funds not only to cover the cost, but also like if there's God forbid, a $50,000 shortage in an appraisal or something, that those funds are also there. So that's something that, in this market that I'm being asked to verify, and this is maybe not in the cash offer situation, but in the other situations when buyers are saying that they're going to cover the shortage on an appraisal, the listing agent wants to know are the funds there? It's great if you're offering to cover it, but if you don't have the funds, so as the lender, we can provide that information and security to the listing agent, say, yes, the buyer will, have the funds to cover that. So that's important too.
Yeah, that's great.
Okay. You want to get to the numbers. Yeah. Anne's like, let's get to the chart.
I know. I'm such a stats geek.
Yeah,
I don't know.
Yeah.
Okay. So the first thing this is the quick one, and that is you're making a $500,000 purchase. What do these interest rates mean to your monthly payment? And there's not much to talk about here except to consider the fact that now's a good time to buy because rates are so low. Save money, save money, save money.
Right.
Yeah, it's just so crystal clear when you look at it like this.
Right. A 0.5% difference means $110 per month. A point difference means $223 a month.
Right.
Carol Ann, what are your colleagues saying about where rates are going this year?
So right now, I mean, the talk is, the speak is from the experts that rates are going to, hold steady this year as far as staying low. Now we have definitely hit the bottom. I don't think we're going back below the threes. I don't have the crystal ball, but just from, the market experts that, I rely on as far as the mortgage rates. There's been a little bit of volatility, but, as far as rates staying low for this year. Now, that's why I've been telling everybody, this is the year. We are not going to have these low rates forever. We all know that. So, I would not be surprised if a year from now we're talking and we're looking at the 4 is where the 3 is, the 4.5 and the 5. That's where we're going to go. Yeah.
Okay. Right. All right. So we were talking earlier about 5% down versus 20% down. Right. And you just did a loan where you talked them out of doing the 20% down, or you didn't talk about it. You gave them both sides and they ultimately chose.
Right. Right. So let's talk about the biggest piece of this issue is, of course, what we call private mortgage insurance. So when you don't put 20% down, you have to have mortgage insurance. And I think one of the things that I find when I'm talking to my clients is that mortgage insurance has a bad reputation. And I think part of this is the Midwest values. It's like you don't buy a house until you have 20% down. That's just kind of like the norm. And don't ever pay mortgage insurance. It's like the evil of all evils. And the reality is it's really not. And when you look at this situation that we're showing here, not everybody has the 20% down payment. And some people do, but it's like they're scraping together and they're going to empty their savings, and it's so like you have to look at what makes sense for you. If you're going to take $62,000, let's say you have only $75,000. You're going to take $62,000 of that and put it down. It doesn't leave you as a homeowner much cushion for when the furnace goes out, or things, life happens. So you need to have the savings. Savings is important. And so you can see here that having the extra $85 a month of mortgage insurance, it's, first of all, it's $85 a month. So it's not $200 a month. Now, mortgage insurance depends on, there's several things that factor into what is your mortgage insurance payment going to be. One of those is your credit score. So the higher credit score you have, the lower your mortgage insurance is going to be. It's kind of the same thing with rates. Anytime you have challenged credit, it's going to cost you more to get a mortgage. It's going to cost you more in rate, and it's going to cost you more in mortgage insurance. So the credit score right there. So the bottom line is, when you're evaluating whether or not you should put the 20% down, don't be afraid to look at the scenario of what the mortgage insurance is going to cost you. The other thing about the mortgage insurance is that it does not last forever. It does not last the life of your loan. So as soon as you reach the 20% or 78%, really equity, you can have your mortgage insurance dropped. So of course, there's two different ways to reach that. So let's say you end up putting, 5% down. So you're thinking, wow, I'm going to have to, I'm going to have mortgage insurance until I make payments all the way to cover that 15% gap. Well, not true, right? Because the value of your house is likely going to increase also. So, right. So here you can look at the 2%, and that's 2%, right? This, as you guys know, in this last year, the value of people's houses have gone up. I don't know, you guys know better than me, but more than 2%.
They've been
in the
going
1
up
year,
around,
right?
yeah,
Right.
way
in
up,
this,
6,
yeah.
8, 9, 10. Yeah.
I think in the suburbs, some people it was like 10%.
Yeah.
So somebody who did
So
mortgage.
your point in this scenario, though, is if somebody holds their home for 5 years and they've put 5% down and they have PMI, and if the value goes up 2% per year, then after 5 years, it's that $415,000 purchase will now be worth $458,000.
Yep.
Right?
Right.
The loan balance, having just made regular payments, will be $357,000. So their LTV, or loan to value ratio, is 78%, right?
Right.
So then,
and so what happens is you have an appraisal done, and you provide your loan servicer with that appraisal, and you request that your PMI be removed. Now, the caveat is you do have to have your mortgage insurance for at least 1 year, and you have to have on-time payments for that 1 year. So you cannot get out of mortgage insurance after 3 months. So you do have to carry it for 12 months. So that's kind of good to know up front, because some people, I'm going to dump a bunch of money into it, and now I'm going to, my loan to value is going to go up. But you do have to carry it for 12 months. But yes, so in this example that you're showing, that's what this person would do. In 5 years, they call up their loan servicer. They say, look, the value of my house is, this $458,000. This is my loan value. I'm at 78. I'd like to have my mortgage insurance removed. And they have to do it.
So the other thing too is, in this scenario, the cost was $5,100, but they've had an extra $62,000 in the bank that they've had invested, presumably earning interest or, appreciating stocks or whatever. Right. So this doesn't account for the gain that they had on that $62,000.
Exactly. And even if it wasn't a huge gain, it was security, right? I mean, if it was their, only savings that they had, they didn't have to give that up, and the cost was not astronomical. So
right.
Yeah,
okay, so we started with PMI here, and we talked about the first one. The credit score determines how much your PMI is. What other things do we need to know about PMI?
So interesting, 2 borrower, it's lower with 2 borrowers versus 1, lower the 15-year versus the 30-year. And of course, like I said, the higher the loan to value, the lower the mortgage insurance. So 90, anything 95 or 97 LTV, when you're only putting a really small amount down, your mortgage insurance is going to be more, obviously. And then the last bullet point there, the interest rate can be lower. It's kind of unique. Now, this is something that I know, right? And it's not all the time. It's when I'm pricing out loans and I play with the numbers, and it's different times, at wherever the market is. But yes, sometimes the interest rates are lower, and
because they've got the insurance. They got insurance.
Right. Yeah, I know. So obviously that's going to be more of somebody who's putting closer to like 15% down. Yeah. It's not going to be lower if you're putting 5% or 3% down. But yeah, so some interesting times as far as that goes.
So
15-year or 30-year?
That was what I was going to ask. What do you advise people to go for a 15-year or a 30-year?
Okay, so this all depends on what you can afford monthly, but let me just give you like a scenario. So I just ran this morning, actually. So again, we're talking about $500,000 purchase price with 20% down. On a 30-year loan, you're going to pay over the course of the 30 years, $207,000 in interest. Okay.
Wow, yeah.
15-year, you're going to pay $97,000. So significantly less. Okay. $100,000 less in interest. The issue, of course, is the payment. So the payment is about $1,000 more for a 15-year loan versus a 30-year. So not everybody has the flexibility to have, $1,000 more payment. It is significant, right? So if you can afford to do it, obviously do the 15-year. But realistically, I'm seeing, more people doing the 30-year fixed. So the interest rate's lower for a 15 as well. So that's another, but yeah, I mean, if people have the room on the monthly payment, I always run the numbers for a 15-year and a 30-year, because when you start to look at that interest, I mean, it's mind boggling. Most people, when they're taking out a mortgage, they don't want to even know that number, to be honest. It's like, I know I'm going to be making this payment for a long time, so don't tell me how much the interest is going to be.
Well,
but
can
now
people
prepayment
also
penalties are not allowed anymore, right? So you can make extra payments.
Oh yeah, you can make extra payments. Yeah, there's no prepayment penalties, and you can make extra payments.
So isn't that the way to go? Sorry.
Well, yes, because some people like to do that because maybe they get a big bonus and they're not sure how much their bonus is going to be. It's not their income. They're using that type of income to do that. Because they don't know up front. They're not secure enough to say I can afford the $1,000 every month. But when I get a bonus, I'm gonna, pay down. Yeah.
Or you can set it up as a 30-year, pay the same amount as you would pay for a 15-year, except in months when you can't, or it's a bad month for you, and then you go down to the regular payment.
Correct.
So you can sort of, with a 30-year and a mindset of a 15-year, you can significantly reduce your interest, is what you're saying.
Right. And that's, if you're disciplined and you set it up, or you do it that way. And then if you want the flexibility of not having to do it, you just do the 30-year and then you make the extra payments. Yeah.
Are we ready to go to bridge loans, talking about what to do when somebody finds a place but still has to sell their home?
Yes.
Can you tell us about? Yeah,
that's what's going on right now. There's just, so let's talk about that. And then we'll get to, how a lender can help you in this crazy market. So, yes, most people now, they're like looking, I want to buy, but I haven't sold my place. How do I get the equity out? So there's two different ways to do that. The easiest and least expensive way to do that is to get a home equity line of credit on your current property. Now, the caveat with this, and this is important for you guys as listing agents, is have your clients get this home equity line of credit before they list their house. They cannot do it once you list your property. No bank is going to give you a home equity line of credit. So you go to like a community bank, like Key Mortgage, we do not do home equity lines of credit, but like Huntington Bank, there's a lot of these other. Huntington is a great one. So if your clients are asking you, getting a home equity.
My husband's a Huntington man. This was not a paid advertisement.
I didn't know that. So anyway, yes, and it's very simple. It's very it's inexpensive. I think they charge like maybe $250 or $500, something like that, to set it up. And it's basically like having a credit card attached to your mortgage. So you can take out the equity when you find your new property and you want to use that as a down payment. Now, that means that you're making an offer not contingent on the sale of your current property, right? Because nobody's going to get it. You're not going to get an offer accepted with a contingency. Right. So the other part of this, okay, so the home equity line of credit, that's the easiest, fastest, cheapest way to get the money out of your house. The other option is a bridge loan. If your house is already listed and you can't do that first option, a bridge loan is also available. Key Mortgage does them. It's more expensive, like a couple $1,000s. I mean, it's like setting up a short-term loan, and it's a little bit clunkier. It takes longer to do it, but it's possible to do it. just a little bit pricier. So that's another option, the bridge loan.
But it gets you into the home you want.
Yeah.
You know, in a market where things are flying, it's worth
Yeah.
maybe a couple $1,000s to make sure you get the home of your dreams.
Absolutely.
As opposed, you know.
Yes, absolutely. Yes, it's a good option. It's just now that the home equity line of credit, people are doing that. It's just a little bit easier,
right?
Because you can get that set up like while you're having the conversations about getting your house ready to get listed and all that kind of stuff. It can be done, and so then it's there and available. And maybe you don't need it. Maybe you get closed on the same day, but and that so that's part of it, right? So. But how do you qualify for the new house while you're carrying the old property, right? That's you do have to qualify for both properties when you're not making a contingent offer. So you have to have the income to support both properties. And this is something that the lender will go through, look at the income, see, make sure that the debt to income ratios work. And if they do, then you're good to go.
Sounds good.
Yeah. And then, so let's talk about how in this market, what as a lender am I doing for my clients and how am I helping my partner agents? I think, first of all, when my clients are making offers, I'm, obviously issuing the pre-approval letter with the specific property. I do not issue the generic, you're approved up to a certain amount of money. Those are like worthless in this market. Listing agents want to see that this letter is matching this property. Within 30 minutes of my client's offer being submitted, I pick up the phone and I call the listing agent. Taking the initiative to do that, I cannot tell you how many listing agents appreciate that. What's the phone call about? The listing agent is going to obviously narrow it down to whatever offers are in front of them. And the first thing that they're looking at is the pre-approval letter. And, they're going to have to vet these letters. So they're going to have to reach out. Well, what I find is that the listing agent is so appreciative that they don't have to actually pick up the phone and call me, chase me down. Am I going to answer my phone? So that's one thing. Have your lender, take the initiative to call the listing agent. Listing agent, it kind of, they remember that. So what's the phone call about? The strength of the buyer. So first I talk about the buyer, that all the good things about them, and about, that it's going to be a very, simple, clean, it's a clean file. And then I talk about, of course, if it's one of my Baird and Warner partner agents, the benefit of closing with an in-house lender. Some people don't know Key Mortgage is Baird and Warner's in-house lender. So I'm like, hey, just in case you didn't know, Key Mortgage is Baird and Warner's in-house lender. This is going to be a very smooth, easy, transaction. And then I talk about the benefits of that, in-house lender. That I'm accountable to you, to Baird and Warner. So yeah. So that's extremely helpful. And then again, I have listing agents calling me asking, about the extra money when this appraisal issue comes up. And I, send them an email in writing that I have verified the additional funds to cover any, shortage on the appraisal. And I think, I think just having the lender involved in, when they're, looking at these different offers is important. So
it really does make a difference. It's helped my buyers in a very tight market get their offers accepted. So thank you very much, Carol Ann.
Yep. Yeah.
Well, thank you. You're very busy these days, I take it.
Very busy. Yes.
Yeah, that's a good thing.
Yeah. Yeah. Yeah, it's been fun, but again, it's just like you guys, a lot of people disappointed. I have a lot of buyers going out every weekend making offers. I mean, I have people making offers on simultaneous properties. I mean, listing agents saying, "Gosh, I never make more than one offer on a day, but I'm doing it." And this is an agent who's been around forever. Yeah. So
well,
yeah,
they definitely, the second part of that is they need a good lender, but they also need a good agent who can help them win the day. And so if anybody has questions about that, please get in touch with Kyle or me and we will help you win the day.
Absolutely.
So thank you so much, Carol Ann. There's so much more we could talk about, but of course, every week we're limited to 30 minutes.
Yeah.
And we'll save it for next time when we have you back to talk about the update on the market.
That sounds great.
Thank you.
Great.
All right,
well,
Kyle?
We don't have time for other properties. We're going to have to say goodbye. We'll have more for you next week when we talk about what's happening in the market, what properties are hot, and we'll come up with a different topic. I think we've got to do a show where we answer your questions, because we already I've put together a list of your questions, and we'll get to those next week.
Let's do that. So everybody, please send us questions so that we can answer them.
So thank you very much, and have a great week, everybody.
All right.
Terrific.
You guys too. All right. Thanks.
Bye.
Bye-bye.
Bye.